Good morning, everybody. Oh, shut that off. Good morning, everybody. Welcome to the Flow Show. Hope you're doing well. Morning, Kay. How you doing, mate?
Morning, Ryan. Morning, everybody. Yep, we're good. Ready to rock and roll.
Ready to rock and roll. That's what I like to hear. Right, well, let's rock and roll then. Right, the blame game is being played in China. Top Chinese hedge fund has blamed foreign investors for the stock market sell-off. Nothing to do, of course, with the poor performance of the Chinese economy. Wanting players to get out of China, or the ongoing spat with the rest of the Western world and the US. Nothing to do with that whatsoever. Why people want to get out of China. Anyway, blame game, there you go. Chinese banks may expedite existing mortgage rate cuts. That's according to the Securities Daily. So you may want to speed up those measures going into play over there. JP Morgan expects the PBOC to cut its rate by 25 pips this quarter. A lot of the banks are ramping up expectations for dollar yuan as well. SocGen sees it continuing. They have now a 760 year-end target. Citi yesterday, I think, saw it through 740 or up to 740 as well. So everyone is starting to get very pessimistic, more pessimistic on the one rate. That depending on who you want to trust in those bank calls, probably means we've got a top in play coming in soon. Because we know what happens when everyone starts expecting extremes. It doesn't usually happen, but we shall see. More headlines coming through about the fixes. China ramps up yuan defense with the most forceful fixing on record. Again, pointing to the fact that they fixed well below analyst expectations yet again. As you'll remember last week, I highlighted that those analyst expectations are the problem, not where China's fixing it. They continue to estimate that these fixes will be higher than they are actually coming in. I think we should start our own fix, Kay. I'll do it late at night when I do the options of an evening. I'll have a look at what's going on. I'm going to start guessing these fixes, see if we can do a better job than these guys. Want to jump in as well? We'll get an average going.
Maybe we should do like a NFP kind of thing, you know?
Yeah, that might be an idea. We'll do maybe I'll do that. I'll do a little tweet late in the evening. Let's all guess the PBOC fix and see if we can beat the analysts. I'm sure we will. Probably a foregone conclusion that we can do that. But anyway, so the headlines are still clickbaiting about those fixes, but it may not be that way in reality. Coming into some of the data, and we had a little bit of inflation data out from Japan. A BOC core measure just dropped down, as you can see there, coming in at 3.3%, well above expectations, well above last month. Yet again, more numbers showing that Ueda may not be quite right with his inflation to drop in the second half of the year call that they've been sticking to. So stickiness there. Not a huge number in itself, Kay, but it's still another one, another brick in the wall, isn't it?
Yeah, consistent with higher data coming in than was expected. Second half of the year in Japan starts next month, right? So he's still in the running. Let's put it that way. If it starts to really come off, but yeah, for the moment it's much more sticky. Well, JGBs are ticking up, but again, nothing too spectacular yet. Yeah, they are ticking up. So now we have to see if the yen sooner or later is going to follow this, or just keeps on the US yields train. Yeah, I mean they're undeniably becoming higher than they are expected. So we have to keep that in mind.
Yeah, very much so. In other news to do with Japan, international investors chopped $9.26 billion worth more in Japanese government bonds than they bought last month. This was the first sell-off like that in 6 months. Obviously, a lot of that is to do with the BOJ shift on YCC. which naturally sent yields higher, bond prices lower. So this is probably something we're going to be seeing a bit more of now in the case of that, because obviously price of those bond holdings, those longs, are going to be coming down. So potential losses for those holding JGBs. But not a big, another headline that's not a big surprise really, Kay. I'm probably going to see it continue if they go again on YCC.
Yeah. Yeah, absolutely. And yeah, you know, there's logic, right, in those moves from in the bond market in Japan. It just remains to be seen, like the opposite of what the other central banks are doing, the other majors are doing. Are they going to stick higher for longer, or is Japan going to stick lower for longer? Is than the market expects. That's the game that goes on right now, right?
Yeah, exactly. Now, PM Kishida is looking to possibly extend the gasoline subsidy, according to TV channel Asahi yesterday. So this is something that was supposedly going to be dropping off, or is due to drop off, and now he may want to extend it. So that's further fiscal measures to depress prices. If that continues, then it's going to delay an inflation pullback or pop back, shall we call it? Because obviously if you're keeping prices depressed or helping people pay prices when that's removed, then you tend to see prices going up again. But he's looking to extend that, according to that TV channel. Now, as far as the yen goes, we're getting a lot of calls coming in now saying that 150 is going to be the intervention level for dollar yen. I'm not entirely sure why they're picking this number out the hat. Maybe just to do with those prior highs up there before we got the pop through, up to near 152. But that's a number going in. JP Morgan sees it there as well. We had an ex-BOJ official out last night as well, early this morning, saying that there'll be no intervention until a breach of 150. Well, a breach may be anywhere above 150. Even 160, so not going too far out on the limb with that one. We're getting into that situation, I think, where if the market is expecting a number and something to happen at that number, it sets up a potential trade, because we will look at the evidence. If we get to 150, what's driving it, how we're getting there, does it tick all the boxes of intervention? Because if the market's expecting that, but all the boxes that we know, volatility, speculation, fundamentals, etc., those boxes aren't ticked as to why they intervene, it could mean that we blow through 150 without a second look, and that will put pay to all those calls at 150. So there's potentially a trade setting up there, trading against market expectations. What do you make of it, Kay? People sticking a number on it again?
Yeah, I mean, we've seen years and years back when they were sitting on the bid at 105. That didn't work, right? Picking a level, picking a price, a level doesn't work. Okay, they will look, as we always say, they will look at the speed, and they may be looking at that trade weighted index, the weight of the yen, because we are trading very close to levels on those on that index, this which is very close to levels where they intervened last year. But then the dollar yen is not at the same level, especially not if we take into account those levels close to 152. But if you look at the crosses, they are actually, the crosses yen are a lot higher than they were when Bank of Japan intervened last year. That puts that index or that let's say exchange rate weight very close to where they intervened last time. Now, are they only looking at the dollar yen? Are they looking at that index? That's still an open question. I don't know the answer to that. What I have to say about Takeuchi-san is that I know the guy. I mean, when I was in Japan, we had several meetings, and he's quite a pragmatic person, and I'm not overly surprised that he is not calling for too quick interventions, because he was not really an interventionist then either when he was head of the FX division in the Bank of Japan. So I'm not so surprised. I think sticking 150 on it is difficult, as we've seen and last year interventions as well. They didn't come in at 145. The first one was around 146 somewhere, and then they waited until above 150, close to 152. But what Kuroda said was true. Every move more than 200 or 300 points per day is considered as overly volatile, and that is what we need to pay attention to. Now, is it, again, the open question now is: are they only watching the dollar yen, or are they watching the yen in general? The yen strength, weakness in general. If the yen weakness is monitored, then we're very close to where they intervened last year. But I'm as you, I'm not going to stick a level on the dollar yen for interventions. But we also have to note that since we are above 145, where the market was thinking that they would intervene, there was only one day where they really commented. And that was the day that we blew through 145 and went to see 146 the next day. They commented, and that was basically it, you know.
Yeah.
And that level up in the 146s is still important enough to me for several reasons, technical, but also those are levels that we hadn't seen since the inflation in the US started to turn around. So I think those levels are still important enough as a gateway to 150, or actually, could we have seen an intermediate top there?
Yeah, very much so. I agree. And so, if you've been following us for a while on the Flow Show, obviously, if you're in our chat room, you'll know that we keep a close eye on the different tick boxes, check boxes for intervention, and we're all over all aspects of it. So we will know if we get to 150, we will know whether it's a likely intervention scenario brewing or not. As I say, that might present a trade. If the conditions aren't met for intervention and we're up 150, that leaves a risk that we go through 150. And if everyone's trying to park the bus there, that's going to be a lot of stops through 150 and probably a decent extension through it. But we'll cross that bridge when we come to it. But know that we've got your back covered when it comes to intervention and when that might properly happen. Right, moving along, and there's Bundesbank out with their monthly report saying German growth largely seen flat in Q3. Private consumption will maybe recover, but industry to remain weak. Inflation could persist above the central bank targets for longer. A bit of a no shit Sherlock comment from those guys. We did have some other data out as well from the UK borrowing numbers. Not something I keep a huge eye on, just a general glance just to see what's going on. The numbers overall looked okay. Public sector borrowing not as much as expected. These numbers can be quite volatile. There were some big tax receipts in there from self-employed people. What I have picked out from that is that borrowing for the first 4 months of the financial year is up 14 billion on the same period last financial year. That's probably to be expected as well, given the rise in interest rates, and also obviously interest payments have gone up due to the rise in interest rates. So the payments they have to make on bonds that they use for borrowing. Overall, I would say nothing that's waving any red flags, but nothing that looks as good as the numbers suggest there. There are a lot of dropouts happening as well, i.e. the energy subsidies that were in play. They've all washed out or washing out now. That was the government basically giving cash to all us lot to pay our bills or help pay our bills, which stopped a few months ago. So that's coming out as well. Over to the US, and there was a labour report out, a labour survey out from the New York Fed. They cite this survey, and it showed that the proportion of individuals who were looking for a job in the past 4 weeks declined to 19.4% from 24.7% in July last year. So that means there's less people looking for work apparently from this time last year. The satisfaction with wage compensation, non-wage benefits and promotion opportunities at current jobs all improved. There was an increase in the percentage of people who are changing up jobs. On the wages front, there was some fairly good news as well, or good news for the people getting jobs, not so good for the Fed looking at inflation from wages. And this is based on the conditional on expecting an offer. The average expected annual salary for job offers in the next 4 months increased to the highest reading of the series at $67,416. Now, a different number, and this is the average reservation wage. That's the lowest wage that respondents would be willing to accept for a new job. Reached its highest reading of 78,645. That was up from 72,873 last year. So overall, the too long didn't read scenario from that is that, as said, people looking for work is dropping, but wages are going up and wage demands are going up. Again, that's not the best cocktail for the Fed. They don't want to see a wage spiral happening as potentially employment drops. That's not soft landing news for them. So this might be something that they keep a closer eye on. We have seen wages ticking up in various other metrics. So it needs to be watching because it could bring a second round inflationary hit on top of the one we've already seen last month, inflation going up. One to keep an eye on. That's it on the headline front. Kay, you got anything from your magic screens?
No, not really. There's already some speculation starting about the next round of talks about over the budget in the US, but that's not before the end of September. So people like to be early. Goldman says that a US shutdown is more likely than not over the next discussions on the US, what is it, the debt ceiling or so. We know that they have found a temporary agreement, but now, I mean, that story will pick up again in September. But for the rest, I don't think. Yeah, you know that S&P downgraded those banks, right? Yesterday.
Yeah.
That's following up on what Moody's did a couple of weeks ago, and that's about it. It did not. Unless we see some of the dollar setback due to that, but it did not really affect anything which is risk related, like equities or so. No, that's about it. The funny thing with Ueda and Kishida, they had their meeting today, and Ueda was quite easy to say that they didn't talk about the FX moves. So they talked about markets, but they didn't talk about the volatility of the yen. So they still seem to be okay with that.
Yeah, exactly. That banking news didn't really hit anything in as far as stocks are concerned. Well, stock futures are small in, which are well up. There's nothing like that. And the UEDA thing, it's one of those things where they made a point of saying what they didn't talk about more than what they did talk about. Which is more our focus anyway on whether they talked about effects, but they could talk about effects, and it doesn't really matter until we get the stronger signals. We just listen and deal with it. Brian's asking if there was intervention. Question is how far down that intervention will drive dollar yen. Well, we only had intervention late last year, mate, so it's quite clear on the charts what intervention looks like. You can see that from the candles quite clearly. So if you want to have a proper look, just scroll back on your chart, and you've got the intervention dates there. The Bank of Japan publish them, or the MOF publish them when they intervene and how much by. So you can see exactly what happened and what's likely. Never usually good for more than you know, 200, 300, 400 pips, depending on whether it's expected or not. But their aim isn't to sink it to a particular level. It's just to give the market a knock on the head to say we're here, we're watching, we're ready to act. Not that we're going to drive the price from A to B and keep it there. Ali's saying the pound is stronger because of rate hike expectations, but what about stagflation risks? What can cause 400 to 500 pips haul in the pound if US data doesn't disappoint and higher for longer Fed narrative continued? Well, that's the question indeed, Ali. What would cause 400 or 500 pip move in the pound? Because we've come through all the top tier data, jobs, inflation, retail sales, PMIs, so on and so forth, and we're not moving at all, really. So it's going to take some sort of shock to move this 400 or 500 pips, or a big headline, or a trend to pick up. Now everyone's in the same boat because what's happening in the US and yields are a big story. So US yields have been jumping, but everyone's yields have been jumping. It's a yield story, so it's a bit of a zero-sum game. You know, you can see UK 10s making new highs, the same as US 10s making new highs, the same as even JGBs making new highs since they moved the YCC. So in terms of FX moves, it is pretty much a zero-sum game. Unless, you know, one goes faster than the other, or anyone goes faster than the other. So for now, really, you're trading within the ranges. Cables had a move up to near 128. Let's come into a bit of a shorter time frame. Let's go on an hourly. So we've had a move up to 128. Couldn't get through 128. We got further resistance 123 and a quarter, 128 and a quarter, 128 and a half. But all of this is within a wider range, call it 130, 126s. So it's going to take something new to break this out of it, and that's either going to be the dollar doing something big, or it's going to be the pound doing something big. And until we get something like that, there's no reason why we should move out of any of these particular ranges in a big clip, I should say. We could grind, that's all possible, but I don't see any big, huge moves. Now, obviously, if we do get something like intervention coming into dollar yen, it's going to knock the crosses, which will in turn knock the majors. So that'll be your shock type event to look out for. And then you have to look at what that means. So if they intervene in dollar yen, knock it down 200-300 pips, and we see Guppy maybe going down 300-400 pips, you're going to see cable moving. What do you want to do with that? Will it break through any of the levels we've got, or is it going to go the opposite way? That's what you have to look for. Look for those opportunities. But as far as the fundamentals are concerned, the BOE are on for hiking in September. We're probably going to be at or very close to a peak in BOE rates, but cable still hasn't done anything even through the recent rate moves anyway. So it's going to take a lot to shift this out of kilter at the moment. As I say, it's probably big headlines or a shock event or something like that, unless we just grind a certain direction. Looking at some of the other pairs around the grounds, dollar CAD, that's finding itself well within the range. 135s on the downside, maybe call it 134.95, 90, whatever, take your pick, but pretty much confirming the 135 support. Up top, 135.50s is still the sticky level, but we did have an extension yesterday up to the prior high, so that set another boundary further up there. So decent range for this one to play in at the moment. What it does do, the more times we test each side of the range, the more it sets up the potential for a break trade if we break any of those edges. I got a bit scared out of my 135 longs yesterday when we had this move down here, so I chopped all of those. I'm still long from down below, happy to sit in that, but I'm cognizant of what's happening now, that we are finding things a bit more stickier. We've stopped going up Doesn't mean we can't continue to go up, but we've stopped going up for now, and it looks more solid than anything we've seen previously until we got to this 135 area. So we could be setting up, as I say, a bit of a range play at the moment, but the potential grows for a break. If we break below 135, then that sets up potential to see a steeper loss. Maybe we go through or test this 134, 65, 70 area. Same thing above. If we get through this 70s, likely we're going to have a pretty quick move to 136 and see what happens there. So if you're not in a position, you've got two choices. Trade the range for as long as it lasts, go with a break. Doesn't matter about your bias, whether you think this is going higher or lower. If you break below, then the market's likely taking it lower. So short is what you want to look at. So you don't need a bias for this one at the moment. You just trade the levels either way. Looking at another one, Kiwi has a decent bounce off of the big 59 down here. Again, another one that stopped going down for now, which if you want to catch the knife, that's what you want to look for in the price action. A bit like a lot of pairs and assets at the moment, it's climbing back above the small shorter term hurdles. So 59.40s is where you want to see support if you're long, but we're running into trouble at the next small hurdle. 59.60s can't quite get through there yet. Then we have another level above into 60 coming in, starting around 59.90s. Looking at the trend on its own, things don't really get interesting until we get up to these sort of areas, 60, 90, 61s, the 38.2 fib of this move. So all this action at the moment is all small fry, pretty much. And the same can be said for the S&P. I'll find it. We had these lows down here. Couldn't quite get down to the zone there. Came up, 7 pips short, 6, 7 pips short of the start of my big zone at 43.30, but we got back above this again, short-term level, 43.60, held it yesterday as well on a dip. 43.80 is a bit washed out. Now we're back above 44.10, got another small intermediate level, 44.20, and then 44.30. So all these little hurdles just need to be taken on if this whole thing is going to be reversing. We don't get a real signal for that until we get through 44, 45, 50 in this zone here. I haven't got a fib on there, but I think we must have a fib coming up into there shortly. Roughly, give it that. Oh, come on there. So yeah, just coming up into that zone, we've got a fib 44.40. So that's where the real action happens. For me at the moment, this doesn't mean an awful lot. Yes, it is looking strong because it's taking up these steps. It is a decent rally, 70, 80 pips. So not to be sniffed at, but in terms of turning around this trend, nothing is really breaking just yet until we get through this level here. So this might be the stiff test for this rally. If we can't get through there, keeps the bearish pressure in play, and maybe we have a look down for the lows and see what happens there. Kay, got any pictures you want to have a look at?
Yeah, of course, mate. And I'm going to have a look. First of all, let's have a look on the metals, right? Because the metals are putting in some decent fight, and despite those higher yields, I got the impression that there has been a bit of over positioning, perhaps by, I don't know whether it's the models or any other funds linked to those yield moves. We went a bit too far too fast, and as we can see, these lows here in gold have been holding up pretty well around those prior lows here, and we are above 1900 again. Nothing really has changed. But we have to note that the metals are holding up pretty well. So the dollar yields are one thing, and the yields elsewhere are another. Then you have, like, of course, economic situations. But the thing is that yields you can only play it for as long as your positions allow you to build and build and build. So maybe we have seen a bit of an overbuild of long dollar positions in some areas. So now we are like trying to stabilize here. If we start to go above 1910, why not get back up to that 1925.30? But for as long as yields everywhere remain the same and we don't have a much better global economic outlook, I'd still argue that the metals are stabilizing and not yet. I can't personally call it a reversal yet, although all reversals start like this, of course. But for the time being, and especially for this silver one, we need economic data to hold up and hold up pretty well for this to start shooting again. And at the same time, Treasury, the U.S. Treasury, having enough of their issuances. By the way, there's another 20-year tonight and a 30-year tomorrow on the Treasury issuances. I guess that the 30-year is going to be watched very closely tomorrow, because that's going to happen right before the Jackson, we dive into the hole, right? But anyway, silver went back above this 2270 trend line. We're back above 23. This seems to be a bit of a, I'm not going to say magnet, but kind of a level where the market likes to hang out and take the next direction, right? Around this 23.35. That's where we are right now. Julian, you're asking for buy points for gold and silver? Well, I mean, we've seen those low 22s hold very well. I missed my buy order around 22 because we didn't see it there. But I think any move down to around those 2270s, 2260s on silver, if the situation is not really changing dramatically or rates not bumping higher dramatically, maybe an area of interest. Gold around that 1885, as I've highlighted just a minute ago. Hold on just one sec. Just 1 second here. Okay. Right, that for the metals. Then, yeah, risk is doing a bit better. Ryan already showed the S&P 500 rebounding. Think 4460s or so. Maybe an area of interest, but I think Ryan at some levels closer. As always, and this is really keeping our euro dollar in a range, right? We've done this move, then now we're here, but we have to note that the differentials remain relatively wide. The lower we go, the wider the differentials, right? In the dollar favor, the higher it goes, the less there is a differential, and that's rather in the euro's favor. But we continue to hang around lows, and I think that is what is holding the euro dollar from retracing more. We are currently seeing, let me just do something here, thank you. We are currently seeing some decent bounces in the commodity currencies. Now, as I said, there could have been some overpositioning. Ryan already showed the trend line in the Kiwi. The trend line in the Aussie was rather similar, which is unsurprising because the Aussie Kiwi is
let me guess, 108.
Stuck around, pegged around 108. So now the Aussie is rebounding a bit. I'm seeing the commodities rally. There may be a bit of overpositioning in the dollars, as we are also seeing dollar yen coming off, sterling being better bid, and so. But in particular, Aussie and Kiwi are bouncing pretty hard. I'm kind of starting to suspect there's perhaps something else going on in Australia, because we saw BHP just coming out with their profits, which were actually a lot lower than they were last year. They had, I think, a 37% drop or so. But I'm kind of suspicious that we are seeing some kind of dividend buying going on in the Aussie. We will see what happens into our noon hour here in London and perhaps even the 4 p.m. later today. So yeah, where can we bounce? Well, 64.60 is your prior low on the Aussie. But looking at how it goes and how steady it actually goes, it feels like we may actually try a little bit higher, because we've at the same time, we are not only seeing the Aussie and the Kiwi rally, but we're also seeing stuff like Euro Kiwi coming back down from the highs, 184.5. We're already trading below 182, and look, we are on this trend line in the fib trying to get below there, which would be probably see some short-termers perhaps even run for the exit before the day is over. I'm not sure for how long it's going to last. I don't see a specific economic or fundamental reason why all of a sudden Aussie and the Kiwi would rally on a lasting basis, but we have to acknowledge this, that since yesterday, since we were trading above 170, we had this first spike higher last week, but then yesterday we retested this trend line, failed to go and retest the highs, and now we are seeing a pretty steep setback. Is there any news I missed? Possible, but as I said, I'm starting to think that there may be some kind of dividend payment buying going on. We will have to see, as I said, what's happening around the fixings today. I'm just looking at the questions. Would you be so kind to look at Euro Sterling? Thinking of a long at 85.11. Okay, let's. I thought Ryan already looked at that, but okay, I'll have a look at it. So, regardless what's really going on or the flows that have been seen, we have to monitor what's going to happen around 168.5, 168.40, 50, and then 168 the figure. Those are going to be interesting levels on the Euro Aussie here. We are looking. I'm only on the daily because there's so much. This move has been so violent. I'm having difficulties to see the intra-day levels, but we are coming back to rest on the 198, the figure in the sterling Aussie. I think for as long as we are above 197, nothing has changed, but we'll have again to monitor what's going to happen for the rest of the day here. I'm still quite positive on this one, but I'm cautious, so I'm in only very smalls right now, and we'll see what happens here, and then if ever this comes closer to 197, the figure, which is this broken trend line. On the rest, mention about this dollar rand. The dollar rand has come off. I think it is due to those BRICS, that BRICS summit ongoing, which is buying some time for the rand, or buying the rand a bit of a relief here. But I wouldn't do anything. I will not do anything for it before I know where the summit will head us to. What will be the results in that BRICS summit? But if we see more setbacks and not a lot comes out of that summit, I think we are here in an interesting zone. If ever we get down here into the 1830s, 1840s. Yeah, and dollar China, Ryan and I have a bit of an opposite view on that one, but as Ryan said, it takes two to tango. For me, we held the broken trend line right now. We tagged it, and then we are bouncing again. We have to reckon with what the PBOC is doing. We have to reckon with what the BRICS summit is going to bring, and where the economic situation in China is. So for me, the last bit is still not good enough to make me change my view that that dollar China may be going down, or even maybe topping. I'm gutted that all those banks are thinking that we are going to go higher, because I'd rather not have them on my side. But in the meantime, it is holding around here. I think that's going to be a pretty decent port of call together with 725, and then we're looking at 720s, which to me that is going to be the new 710 is going to be around 720, and if that breaks, then perhaps something is really changing. Okay, of course. We're not talking yet about the big figure, but I already think that 720, and that may be also because the PBOC is trying to keep their fixing max 720 or so. That 720 is going to be a big level, but I reckon that's going to be the break zone right now on the longer term. So, but for the time being, even short to medium term, this one holding is keeping me in my own longs. Euro sterling. First of all, quickly, this dollar yen. Yeah, you know, I've been showing these mid 146s. Well, it kept again. You know, I think we still have to really monitor very closely what's happening up in those mid 146s. Okay, for various reasons. And on the underside, it's 145 right now. If you break 145, there may be an acceleration. Euro sterling 85.11. Is that because it's just the prior low? That's around 85.04. It's 85.11. But then, yeah, well, I mean, Sam, you can buy it there, and your stop is below 85, right? But then beware of those algo stop runs taking it down to 84, 80 or 90, and then seeing a bounce. I find it still, if you look at this picture, heavy, but we need to absolutely respect the 85, the figure, and much more than that. I don't have to say. I'm relatively positive still myself for the sterling right now. So I think there may be a test of this level, but we'll have to see. It's really in the balance here. It is really in the balance. I would say for the medium term positioning. Of course, you can buy it in the low 85s, and you're going to hit the bottom or scoop the bottom and look very good if it goes back up to even 86, 86.15. But for the time being, I don't know what to do with it. As I said, I'm slightly more positive on sterling than I am on euro right here and now. By the way, on the euro dollar, I have absolutely nothing to say right now. We're in the middle of nowhere. That is just pointing out a thinking mistake. Oh, well, yeah, everybody makes mistakes, but if you make a mistake against your own rules, that is not good. So quickly on the cable, I think actually cable, we are around these prior highs, but it looks, as I say, feels good enough perhaps to have a retest into the 128s, just because these levels held pretty well, and I'm looking at the data. Even if it's a bit of a seasonal thing on those lending numbers, I still think that they provide a little bit of support today for the sterling. So I think all else equal, or US yields rallying from here again, there may be a chance that FX disconnects just that little bit more of yields, and we see a move back up in the 128s before the day is over. And with that, Ryan, back over to you.
Thank you very much, sir. Always appreciated your input there. I hope you've answered your questions on that one. Yeah, I mean, you said about euro, dollar, and what I'm feeling very neutral fundamentally on a lot of pairs at the moment. Maybe it's just the summer lull not giving us, we're not getting any talking heads. Governments are off, and central bankers are, like Lagarde, in the south of France, topping up their tans and whatnot. So yeah, we've got to be careful, because once we get around to September and everyone comes back, that's when we're probably going to see a lot of moves happening. The market's setting itself out again what it wants to do. So don't get sucked into false sense of security that talking about ranges in cable and stuff like that. And as much as I don't see any big moves happening, we get into the latter part of the year. That's when the market is going to start making decisions. It's going to want to really start trading potential cuts if they're going to come. And I think that's when things step up in earnest. But for now, just look at your ranges, trade your ranges, and try the breaks and stuff. And if the big levels hold, then that gives you opportunity until we do get some movement. For the rest of the day, we haven't got an awful lot out. Some house price, some housing data from the US, and we get a small Richmond Fed manufacturing and services number, if you keep an eye on that one, just to get another little indication of what's going on in the US sectors. So apart from that, just watch the headlines, see what's going on, watch out for these brick stuff happening. Trade safe, trade well. Thank you for coming to the Flow Show. Thank you, Kay, and we'll see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.